Well, welcome into this year's market update. I'm Tony Mulvey. We're really going to start looking at consumer conditions. I love talking about the consumer, especially when talking with freight and the impacts of freight. And we've got our retail sales and consumer price index chart here. You can see recently kind of a flat line in retail sales, flat month over month, up about 3% year over year. So slower growth, kind of outpacing the overall growth of the economy, but what's not factored in is the inflation aspect in retail sales. So on this chart, we also have the consumer price index. So that gauge of inflation, it's not the Fed's favorite index, but it's useful overall when gauging what those consumer conditions are. It's actually up higher than retail sales. So you're talking outpacing the overall growth in sales. So kind of adjusting for that, it's not a perfect adjustment. Retail sales are basically flat to down year over year. So not a huge concern because it's in dollars, but when you start underlying these trends in the consumer, there's some, I would call them yellow flags on these conditions. And we'll pull up this next chart. And it's one of my favorites because it kind of opens the eyes of what we're looking at when talking about the reaction to the Fed to curb inflation and what consumers have kind of relied on recently. So we've got our Fed funds rate. You can see the increases in that Fed funds rate, that overnight borrowing rate that really the banks they're borrowing. It's the rate that the Fed sets. So you can see the rapid increase where they raised interest rates 9 consecutive times, going arguably faster than what they raised them really dating back anytime in the last 20 plus years. So even more aggressive than what we were leading into 2007, 2008. The difference is really what you're seeing is consumers are relying more on credit. You can see the total outstanding revolving credit, that trend line in the orange line there. It's pretty fast, it's aggressive, it's faster. It's growing faster than what it was prior to the pandemic. But the flip side of that, delinquency rates on credit cards are starting to rise, but mortgages and things that led to that great financial crisis, they really haven't changed a whole lot. So what you're seeing, higher interest rate environment, consumers using credit, tepid spending growth. But we'll move here to our last chart on the econ side and look at housing starts and flatbed rejection. So housing starts saw a really kind of slower start to the year. You saw an increase, then you see a quick decline. The decline in March, I wouldn't read too much into it because it was 1 month, fairly sizable decline. When you see the uptick, you really saw growth in single-family housing starts. They're up about 17% year over year. So seeing growth in there, you'll see that can kind of continue. You see leveling off in the flatbed rejection rate. It kind of is that leading indicator of where housing and the industrial economy is going to go. You see it still kind of trending upward from its bottom kind of mid last year. So overall, seeing a little more positive signs. ISM's Purchasing Manager Index came in below 50 this month, so a little slower on the manufacturing side, but housing still doing okay for the moment. So right now, I'll turn it back over to Mike for our rail and intermodal update.
Great. So I'm going to take you through 4 quick rail intermodal slides. And if we can bring up the international intermodal slide, that's really where the action has been in the rail intermodal industry this year. So year to date, total intermodal volume has been up about 11%. But really where the action has been on the international intermodal slide, international intermodal segment, which that volume's been up about 24%. So that's international intermodal segment. That's the 40-foot containers that are loaded. Those containers are much more tied to the ocean markets, which have been strong with a lot of the inventory replenishment. And it's also shown that the container ship lines so far have been very willing to send those containers inland to points like Chicago and Dallas. and not needing those containers back. Now that may change coming up now that there's been so many reports all of a sudden of a shortage of international ocean-going containers. So I do think you'll see more transloading. You do have the right slide there. That's international intermodal containers. 2024 is in white. You see that well above last year in the light blue. If you want to go to the next chart is domestic intermodal, and you see that's been up much more modestly. That's been up about 3.5% year over year. So this is the data set that you want if you're a stock analyst and you're trying to analyze J.B. Hunt's upcoming earnings, or Hub Group, or Schneider. We're going to hear more about stocks later on from Seth Holm, but this is one that I always talk to stock analysts about because it is a good representation of what those domestic intermodal companies are seeing in the field, and a good representation of, if you think about how much maybe capacity is out in the market. One of the big takeaways from this last round of earnings calls was, J.B. Hunt said they could move an additional 20% intermodal volume with their current fleet of containers, and you can sort of take this volume data and judge based on that sort of qualitative assessment of capacity. If you want to go to the next chart is should be, if you want to go forward ahead, one is intermodal contractual rates. And so these intermodal contractual rates sort of year to date down about 3.5%. It was a fairly aggressive bid season where a lot of the shippers that we interact with had intermodal bids that were down 10% or more. Starting last fall into earlier this year, the intermodal contract rates down about 15% on a year-over-year stack. So it does reflect an excess of capacity in the marketplace, including domestic containers. And for a lot of folks in the room, maybe shippers want to know how this relates to the truckload market. If you want to go to the next slide, we have the intermodal savings rate. And one of the comments I get frequently is why would someone use intermodal right now, because the truckload market is so loose. And if we're talking about, and this is the right chart here, is this intermodal savings rate. And if you're talking about shorter haul intermodal, I'm right there with you, where we're really not seeing a lot of savings on the shorter hauls. So it's 3% and the hauls between 400 and 800 miles intermodal versus truckload when you include fuel for both modes. Even on the medium haul, more like 5%. If you just look at those lanes that are greater than 1,200 miles, we're seeing more like a 16% all-in savings versus using intermodal versus truckload. So still plenty of value proposition there on those longer lengths of haul. I'll now turn it over to Ryan to talk about the international markets.
Thank you, Mike. Zach, if we could go back a few slides. Keep going, keep going. One more. There we go. Okay, cool. Yeah, so I'll be talking about our inbound ocean shipments. Go back one more. There we go. Inbound ocean shipments index to the U.S. So this is representative of all ocean bookings that are coming into the United States. As y'all have heard from many of the keynote speakers this conference, this down cycle in freight really has not been a story of falling off demand. Demand has held strong throughout the cycle. It's really been an oversupply of capacity, and this chart here tells that same story. So what we're looking at here is year over year ocean shipments inbound to the United States. The white line is current year. That blue is 2023, and then that red line is pre-COVID 2019. So what we can see here is the trend is up. We're up year over year. We're very elevated above 2019 levels. As we know, though, these are shipments, so not all BOLs are created equal. A shipment can have one TEU, it can have many TEUs. If we want to go to the next slide, we can also validate the TEU volume. So this is inbound ocean TEU volume index to the United States, and it tells the same story. So what we're seeing here is growth year over year. Volumes are up. We did see that surge in shipments leading into the February, March months and a little bit of a fall off, but that seasonality shows up year over year. So nothing to be concerned about there, but the volume is up. These are still plentiful containers, TEUs coming into the country. And if we want to go to the last slide for inbound index. So this is a three index chart here. And what I want to hit home with this is something that Ryan Peterson from Flexport touched on a little earlier, and I think Zach and Craig also talked about. But this is showing inbound ocean TEU volumes between China and the United States, which is that white line. It's showing inbound TEU volume from China to Mexico in the blue line, and then that yellow line is our outbound tender volume index. So that's full truckload tender volumes outbound from Laredo in the yellow line. And this is all relative on a 5-year basis. And what we can see here is that inbound volume from China to the US is only up about 30% over a course of 5 years. But what we're seeing is a surge in inbound imports between China and Mexico. A lot of that Chinese, work in progress goods, those widgets are now shipping into Mexico. There's some assumption that that's to avoid some of the tariffs. Some of it's just cheaper labor that's being stood up outside of China. And so we're seeing a surge in China to Mexico inbound shipments. And because of that, the progression to get that good into the United States is then to ship it cross-border Mexico to the US. And so we've written many articles about this, but we're really seeing a boom in Laredo, Texas, as a lot of that freight passes through the border and enters the country. So from a supply chain shipper perspective, it's something to be considerate of as these supply chains start to shift. Zach, over to you.
All right. We'll go to Good Times with Charts continues. Outbound tender rejection index. We talked about it yesterday. The domestic truckload market still soft, but this thing has popped up. Road check week, Memorial Day are in the rearview mirror. We're still seeing some strength in this number. It's starting to have some upward pressure on it once again, even after these holiday periods have passed. Normally we see some things reject, smooth out a little bit. It's still 4.3, 4.4%, but it's not falling dramatically. This is the time of year where we expect a summer peak season, not necessarily as publicized as the winter peak season, but there is some optimism here from the transportation service perspective in the way that they may have some legs to stand on, some optimism moving forward for the future. Doesn't mean the market has flipped sustainably though, so we're only a few days out of that. The next chart here, looking at the contract rate versus the spot rate, this is another indicator. I'm looking at the spot rate on the green line on the bottom, and I've drawn a line, forward-looking, linear regression line. It's not a great forecasting tool, but it is helping to understand the direction of the spot market, which does lead the contract space. Spot rates are still well below contract, but there is some upward momentum in this indicator telling us that the market is showing signs of tightening. The contract market will follow at some point. It will be interesting to see if the spread being so high and so elevated actually continues to be an issue. The spot market is overweighted with freight that carriers are using for utilization, just keeping their trucks running. Craig and I talked about it yesterday. Cash flow is king right now to keep their debt levels under control and continuing to operate. So the spot market spread being so wide isn't necessarily as big of a tell as it once was, although it is still an important tell in that, directionally speaking. Now for the really good news from the transportation service perspective, and also from the shipper perspective, the outbound tender volume index, one of my favorite to talk about because it influences everybody. It's an economic indicator, if you will, for goods demand. And look at this nice sharp increase coming up after that holiday trough in the white line that we're looking at. That means demand is growing pretty significantly. There's always a little bit of a bump at the end of the Memorial Day period coming out of it, that holiday week. We tend to see shipments really increase on the truckload side after that, but this is a pretty strong increase coming out of the holiday, indicating that there's a lot of shipping activity going on in the space. Also, that means that the economy is not showing any signs of slowing down from the goods side perspective at least. So last but not least though, that goods demand, the demand side increase isn't equal. We're looking at long haul outbound tender volumes with all the other various lengths of haul. The big takeaway here though is in that white line at the very top. So that is the COTVI, or the local city outbound tender volume index. It is an index of loads moving less than 100 miles. This thing is growing tremendously. There's a lot of upstream activity going on, a lot of intra-warehouse moves, upstream industrial activity going on that's helping propel this. This could be an overall shift in the landscape as supply chains have been moving to more of a closer to the end user fulfillment cycle, supply chain reorganization. It hasn't necessarily eroded any demand from the long haul side. It's eroding demand, what it appears like, from the mid haul side. Our loads moving about 250 to 450 miles, or about a day's transit. So this is a much more efficient system, which may help ease some of that capacity congest tightness later in the year. But the long haul side is still going super strong at a 9% year-over-year growth. But that local haul situation, definitely something to monitor. So that being said, thanks for watching, and have a good rest of your conference.